Multiple time frame analysis. Using multiple time frames is something that leads to confusion for most. Various time frames can be in conflict with each other. They can certainly form different types of pictures. So we're going to have to choose what time frames we're going to look at and understand how they interact together. This will be the essence of this section, understanding how to put together multiple time frames, understanding how the pictures change between time frames, and how to put together a systematic way of choosing one time frame for a bias, another time frame or lower time frames for entry to refine or take x-rays into that higher time frame for entry points. Let's begin. When all time frames are in alignment, trading odds will increase. But again, this rarely occurs. Trend analysis that you've learned is an objective method to determine what the stage is. All four stages can happen in different time frames, all at the same time. So waiting or expecting for all those time frames to be in alignment can lead to indecision. But you're going to have to decide what time frame you're going to trade in and which will gain a longer time bias from. Then you'll apply your tools that you've learned. Trend analysis, supply and demand, bar by bar analysis, to find those opportunities in that time frame. Why we view supply and demand in multiple time frames. It gives us a look into patterns within a pattern. This allowing us to refine entry points in a shorter time frame when that longer time frame provides us the bias. We can determine when a shorter time frame pattern may fail. It says this often occurs when that shorter time frame is trading against that of the longer. We can also determine when a longer time frame pattern may fail. The shorter time frame forms a pattern failure, such as a shakeout, breakout bar failure, M or W patterns. Realize all pattern failures in higher time frames begin in shorter and then evolve into the higher time frames. We also use it to determine when multiple time frames or voids are in alignment. This increases the odds of follow-through in their direction. Multiple time frames provide us different pictures. This is what pattern recognition is. It's recognizing pictures, and different time frames change those pictures. In other words, they manipulate the data to forming a different picture or view which can communicate the direction of prices. You may not see it in one time frame, whereas looking at it in a shorter time frame or a higher time frame may give you that picture. In a choppy market environment, using a higher time frame to compress the data will make that choppy action something that you can recognize as to giving you the direction of prices. Whereas in a very strong market with strong momentum, smaller time frames will provide you the pictures that show you that slowing momentum and entry points into that strong trend. The multiple time frame matrix simply says, what is your primary time frame? Once you've chosen that, don't fade or trade against the time frame above. Let it confirm or at least be neutral. Your primary time frame is the one with the compelling pattern that tells you where you want to take your position. Once your primary time frame is in alignment with the higher time frame, it's okay to move to a lower time frame to gain entry. And you can refine an entry into that lower time frame. And if you want to go below that, if you're an active trader, you can enter from even yet a lower time frame when that's in alignment with your primary time frame. This is how the matrix would be used. If the daily is your primary time frame, you've come across a consolidation pattern, and within that consolidation pattern you have an alert day, meaning you have a bottoming tail bar which took out prior bar's lows and closed on its high within a consolidation. That alert says that prices should move higher above that bar's high. So you go step 2, the higher time frame, in this case the weekly. And our rule says don't trade against this higher time frame unless it's in alignment. And it is. In the weekly time frame we have a strong move up, and we have a consolidation here, still supporting the idea of a move higher. And so the breakout was forming in alignment with the daily time frame. Now, if you need to, you can move down to the 60-minute time frame or the 15-minute time frame, which is now also when those patterns are in alignment with the higher time frames. Realize at the moment those lower time frames may not be in alignment with the higher time frames. But when they are, you'll have a high probability pattern. As I would say, with a pattern like this, go for it. Multiple time frames are in alignment. Prices should go higher. Step 1, compelling pattern. Climactic buy setup with a bottoming tail, but it's not a range expansion. Next step, go to the weekly. Don't trade against the higher time frame. Right? We want it to be in alignment. In this case, the weekly time frame is still in a downtrend and moving lower. We have bearish red bars. Right? No sign of stabilization. So at this point, there's no reason to go any further. Right? The weekly is not in alignment with the daily. This daily climactic buy setup is not a pattern that we're going to trade. There's no sense in going to the 60 or the 15-minute. Put a stock like this on your watch list. Right? Since momentum is slowing down, maybe something will develop in the coming week or two. Step 1, we have a climactic sell setup with a topping tail in an unfilled gap or an area of resistance suggesting prices should move lower. Step 2, go to the time frame above our primary time frame. Here we have a W pattern, right? A W pattern indicating prices should move higher. This is no good. Right? W pattern suggests higher. Climactic sell setup topping tail pattern suggests lower. They're not in alignment. Now, no trade. We don't go down to the 5-minute. We don't go down to the 2-minute to perfect entry, since our primary time frame is not in alignment with our higher time frame. This is a key slide to understand about bearish bars being ignored. Once a longer time frame gives you a bias, and in this case an upward bias or a bullish bias, red bars are going to form. Those red bars or bearish bars should be ignored. What happens is, as those bearish bars form, that correction, right, is a pullback within that bullish move. In a smaller time frame, you have multiple bars moving down toward an area of support. In other words, a PBS. Every transition from a red bar into a green bar must have slowing momentum and a reversal. In other words, a type of PBS setup. Right? So once we have a bias from a longer time frame, and saying prices should go higher, we can then drop down to a smaller time frame, and within those corrective bars, within the higher time frame, momentum will slow down and we're looking for that transition or buy setup in a smaller time frame. But this is a way of getting on board a higher time frame that's moving higher. Our expectation is that the bearish bar has greater odds of being ignored because of the prior bullish signal. These patterns in a shorter time frame give us an X-ray or insights into the direction of the longer time frame. In this example, within a consolidation, meaning overlapping price bars, it doesn't give us much information. By moving down to a smaller time frame, in this case the 5-minute, we see an M formation. M formations communicate distribution and lower prices. Here we're recognizing or seeing support and resistance in multiple time frames. We've talked numerous times about a cluster of open and closes. What we're seeing here on the 15-minute chart, that cluster of open and closes, is actually a consolidation on the 5-minute chart, and why we focus on that open areas of opens and closes. That consolidation is likely to stall prices, and why we use this as a minor area of resistance in this case. Now, it doesn't mean it cannot be overcome, but any area of consolidation is likely to stall momentum as traders take profits and or exit positions that they may have gotten stuck in at that time. So it's about recognizing the areas and understanding why momentum slows at certain times and why at other times it continues in the direction that it was moving in. Longer time frames tell us when the odds are a shorter time frame will fail. Here we have a PBS forming on the 5-minute chart right at price support, where we have a PSS on the 15-minute chart at price resistance. The 15-minute chart saying prices are going to move lower. The 5-minute chart suggesting prices could move higher. And you see that PBS is forming right at the bottom of the bearish chain of the guard and that narrow body on the 15-minute. Other things that are not attractive about this 5-minute PBS, regardless of the 15-minute chart, is that it began to the downside with a bearish wide range bar. So strong momentum to the downside. Although it stopped at the 200 MA and support, it is not a PBS that we would want to take. It's a low quality PBS, and actually one that suggests failure. And we've marked a measured move lower here as the changing of the guard failed, breaking the lows, and then setting up a measured move lower from there. Our 5-minute trend is down. In other words, our longer term trend is down here. There's a greater than 100% retracement. And prices originally had fallen on the 5-minute chart. They retraced up from that, and then there was a 100% retracement back down to the low. So this was also a bearish pattern on the 15-minute chart, or a bearish chaining of the guard. This gives us a bias that prices should move lower. Of course, we're going to make sure that there's a void below. Now, as prices retrace up on the 5-minute chart, we can refine to a 2-minute chart as prices move up into the congestion above and form a PSS. The PSS on the 2-minute chart is the transition from the green bar into the red bar, and then the move lower. Those that are using the 5-minute chart would just be shorting under the red bar's low. If you want to refine with the 2-minute chart, here you're getting a recognizable pattern or a retracement closer to the resistance at the top of the green bar into the red. And it's just a transition. This is how all transitions occur, from green bars into red bars and vice versa. There must be a slowing momentum, a narrow range bar, known as a PBS or a PSS. Multiple time frames and patterns in alignment. We have a daily chart in a downtrend having retraced up to price resistance and topping tails beginning to form. Moving to our 5-minute chart, we see an end of day base. Okay, so prices must have declined in the morning and then consolidated in the afternoon inside of that topping tail. So the supply is just overhead. First thing in the morning is a wide range bar igniting to the downside, suggesting prices should move lower. As prices retrace up to the consolidation at end of day base is a 5-minute topping tail. Moving down to the 2-minute time frame, we see a PSS forming right into that area of supply. We get the red changing of the guard, or a topping tail on our 2-minute chart, shorting under that low. We're getting in on a PSS on the 2-minute, which is right near the top of the 5-minute topping tail bar. And don't feel compelled to trade because of a fear of missing out. Use your multiple time frames to refine and gain entry points. Gaps are not always filled. Here we have an example of a gap down, and prices gapped under that area of congestion. That immediate area of supply to the left we view as being transferred into the current day. And so we do have a void above that consolidation. And so waiting here for that supply to be transferred, we see that 2 bars formed on the 5-minute, and then they broke down to a new low on the day. This gives us our bearish bias, looking for prices to move lower. We can then move down to the 2-minute time frame and take that X-ray into what's happening there. And so as prices moved up on the 5-minute, you can see that small candle body or bottoming tail bar by the blue star there. Within those bars, that consolidation, we can see the 2-minute moving up into the resistance and forming topping tail bars. Notice on the 2 minute, the last topping tail bar prior to the breakdown closed on its low. To reinforce, again, consolidations with tails. When we get a tail bar that closes on its low, we have a bearish bias here. That is the signal that prices should start moving in the direction of our bias. Our daily chart is the bearish chaining of the guard, or PSS. Moving down to the 60-minute chart, we see prices have begun to move lower and they're consolidating. On our 5-minute chart, we see prices moving up toward the area of a prior high, an area of supply. We have a bearish daily, bearish 60-minute. Use a smaller time frame to gain entry into those bearish patterns. Now the short-term strength that was occurring on the 5-minute chart, as we say, should be respected. So just wait for that bearish chaining of the guard to form, and in this case, it formed a potent bearish chaining of the guard. What we're seeing here is an M type of top on the 5-minute chart, which is in alignment with the longer time frames that are supporting a bearish bias and a move lower. On this 15-minute chart, we had a PSS right where it says no follow through. There was strong indication of those reversal candles. We don't know how much they're going to follow through, but looking into smaller time frames can give us insights to whether their bearish patterns are forming there. In this 2-minute chart, we see bullish consolidations rather than bearish patterns on the 2-minute chart. So while you did have a PSS on the 15-minute, the 2-minute was saying prices are not ready to break down yet, and they didn't. And they moved up, and look at the second blue star there, just where the doji is, and when momentum had slowed down, you still had a bullish angle of retracement, and prices were moving higher. And then as they continued to move higher, you see the bullish wide range bar formed right up at the 200 MA, and that consolidation up there we can see on the 2-minute was forming an M formation, which was bearish, suggesting that prices would move down from there. Our daily chart here is bearish. We had a wide range bar, a bearish wide range bar igniting a move lower. It was stabilization and a retracement back up with a bearish chaining of the guard. So an obvious short setup here tells us that traders are short overnight. The gap up causes a shock into that bearish chaining of the guard, and in this case we have an end of day base. This is what's producing failed expectations. Well, it's okay to trade against the prior daily, suggested when we have a new intraday pattern. We had a 5-minute pullback and a bullish chaining of the guard into the gap fill, and an end of day base would avoid above. So as a short-term trader looking for a scalp type of trade that might last 15 minutes or a half hour or so, here is an attractive pattern. A PBS type of a pattern into a gap fill, narrow body, bullish changing of the guard, and looking for a move higher from there, at least to and above the high of the day. And so if the issue was to close at the high of the day where it was trading right now at around 45.80 to 4600, it would be above the high of the bearish changing of the guard on the daily. And then there'd be the potential for a failed daily pattern as well, and a move higher into that price void. Our 60-minute chart here is turning bearish. Or had previously to recovering. We had a breakout bar failure at the high and a wide range bar moving lower. Now it did fall into a demand area, or an area of major support. Had it broken down below that area, we would have had a clear signal of changing trend. The wide range bar failure can be seen on the 5-minute time frame. Looking over the 5-minute, we see multiple bars moving down. This clearly shows you why a wide range bar creates a price void, multiple bars moving down in the smaller time frame. From there, prices retraced back up again, and did suggest that they could break the low as they moved down toward that low. And then we begin to see signs of stabilization. We see no follow-through on the 5-minute, no follow-through to that bearish bar, and prices retrace deeply up into that area of supply. This indicating that demand was picking up. Note the angle of retracement on the 5-minute time frame. Notice how it pulled back. Look at the bottoming tail bar just prior to the bullish changing of the guard. It breaks below the prior lows. Now this didn't result in prices moving back up. Overall at that time, the 5-minute chart wasn't positive just yet, but it was improving. Then again, it moves lower from there. Now, this is all within that bullish angle of retracement, that consolidation on the 5-minute, and then there's a wide range bullish bar, this igniting a move higher. It was clearly telling us that demand was picking up at that time. And then as these prices started to move up, we can see that bearish bars are being ignored on the move higher. And so demand continued to pick up and move up into that price void. And when wide range bars form, in this case a bearish one, if prices do not follow through, typically within 2 to 3 bars, and prices move above those bars' highs, odds are prices are going to retrace back up toward the high of this bearish bar. A doji bar is considered a strong indication of change. As you know, we view it as only slowing momentum. It doesn't necessarily mean change is going to occur. Remember, there's no guarantees here. Right? A shorter time frame can reduce the risk of our entry if we're thinking to short this pattern. That said, analyze the daily chart. And is it a good setup? You can stall the recording for a second and just take a look at this daily chart and do a bar-by-bar analysis of what happened. What we see with this daily chart is that while prices did move down aggressively, note the wide range bar moving down on huge volume there, when prices broke down under the lows there after the 2-bar consolidation, there was no follow-through to the continuation bar. A bottoming tail bar formed, and then a narrow range body, and prices rallied almost 80 to 90% toward the high of that bearish wide range bar. Now in this case, while there's a doji bar, and a doji bar is considered an indication that prices are going to pull back, this wasn't a good daily pattern to consider as a short. Now from an intraday point of view, it's always possible for prices to decline. But what we see happen here intraday was that prices gapped down the next morning, and the first 5-minute bar closed on its high, never giving you any reason to even thinking about shorting it. As prices moved up into the gap fill, they still never broke below a prior bar's low. Even notice after the momentum stalled and prices broke to a new high in the day, there was a breakout bar failure, meaning prices broke to a new high in the day. It was a minor topping tail, followed by an inside bar, and prices broke below the inside bar's low. That said, prices never actually broke below the breakout bar's low, confirming the breakout bar failure. Prices then continued to move higher during the day. So while the daily chart was suggesting at least some type of a retracement, once momentum had stalled, the intraday time frame was actually bullish throughout the day, and prices moved higher. When multiple time frames are moving together, this offers the best success or best odds of a trade. On our daily chart, it had become climactic. Notice the narrowing range, red bar, range contraction, and the gap up from that bearish bar. The intraday patterns were all bullish. The 60-minute chart had a void above, and there was a bullish consolidation at the blue star. The 15-minute chart consolidated after the gap up and the move higher. From a gap up or a momentum move higher creates a void below. This consolidation was creating support where there was none. And then the 5-minute chart, you can see the breakout and the 1, 2, 3 continuation pattern all having a void Here we have a high quality setup with multiple time frames, all suggesting prices were moving in the same direction. As we reviewed, wide range bars and longer time frames are momentum moves in a shorter one. These wide range bars create price voids. So question, is the supply and demand in the smaller time frame at the beginning or end of the wide range bar? Do the analysis just like we did in our gaps section. Pattern failures in a longer time frame begin in shorter time frames. So recognize those breakout bar failures and those shakeouts. It's okay to trade against a longer time frame in a shorter when there's a price void in the shorter and the shorter time frame pattern suggests a retracement. Right? M formations and W formations. When prices in a longer time frame are trending toward that supply or demand within a void, it's okay to enter from a shorter time frame when a pattern supports an entry, meaning a PBS or a PSS. As we've covered, bearish bars in uptrends should be ignored, and in a smaller time frame, you'll find that transition into the green bar or a PBS. Supply, demand, retracements, bar by bar analysis, all of these will be your guide to those high probability trades.